On a Friday afternoon in 1926, an American factory worker could finish a shift, collect a pay envelope, and be told not to return on Monday. There was no unemployment office waiting with a weekly payment, no online claim, no federal state insurance system replacing part of the missing wage. In most places, the worker left the gate carrying whatever cash remained from the last paycheck and the knowledge that rent, food, and fuel would continue to cost money even though the job had stopped. And yet recessions, layoffs, and seasonal shutdowns were not new. So how did American families survive unemployment before 1935? The answer depended on savings, relatives, charity, local relief, and luck. When all of those failed together, the country discovered that joblessness was not only a private misfortune, it was a risk capable of pulling the entire economy downward. For much of the 19th century, unemployment was not measured or administered as a distinct national problem. A person without wages might be described as idle, poor, displaced, or simply between jobs. Work itself changed with the seasons. Farm labor rose and fell with planting and harvest. Construction slowed in winter. Dock work depended on ships. Factories reduced hours when orders weakened. Families learned to expect interruptions, but expectation did not make them affordable. The first defense was the household. Workers saved when they could, took in boarders, kept gardens, repaired rather than replaced clothing, and relied on several earners under one roof. A spouse might wash clothes, sew, sell food, or take domestic work. Children often contributed wages. An adult son or daughter might postpone leaving home. The household functioned as its own insurance pool because no larger institution guaranteed help. This system could be resilient, but only when at least one person still had income. If a factory closed across an entire town, several members of the same extended family might lose work at once. The relatives expected to help were suffering the same shock. A private safety net woven from close relationships could tear precisely when it was needed most. Workers also turned to mutual aid societies, fraternal organizations, religious congregations, and ethnic associations. Members paid dues and received help during sickness, death, or hardship. These organizations were important, especially for immigrant communities excluded from established institutions. But their resources were limited. A society supported by working people could not pay large benefits when many members became unemployed together. Labor unions sometimes offered out-of-work benefits. A union fund could help members survive a strike, seasonal unemployment, or a temporary closure. The benefit also protected bargaining power. A desperate worker would accept almost any wage, weakening standards for everyone. By supporting unemployed members, the union could prevent employers from using hunger as leverage. Coverage was narrow. Many workers were not unionized. Women, black workers, agricultural laborers, domestic workers, and people in unstable occupations often had the least access to formal support. Even a strong union could exhaust its fund during a deep downturn. Private arrangements managed individual hardship better than mass unemployment. Local government offered another form of relief, but it carried the legacy of the poor law. Assistance was often designed to distinguish the supposedly deserving poor from people considered able to work. Applicants might face investigation, public shame, or the threat of entering a poorhouse. Relief could be given as groceries, coal, or rent support rather than cash. Local officials wanted to prevent hunger without creating what they viewed as dependency. The moral language around unemployment mattered. If joblessness was treated as evidence of weak character, assistance could be deliberately humiliating. A worker who had lost a job through no fault of his own might still have to prove that he was willing to work, had searched everywhere, and possessed nothing valuable enough to sell. The system asked the unemployed person to demonstrate poverty before offering help. Economic change made this approach harder to defend. Industrial workers did not control whether a national market collapsed or a factory owner cancelled production. A skilled machinist could be unemployed because customers hundreds of miles away stopped buying. A miner could lose work when a railroad reduced demand. The causes of joblessness were becoming national, while relief remained local and personal. Reformers began to argue that unemployment should be insured like an industrial accident. The worker and employer would contribute during good times, creating a fund that paid benefits during temporary job loss. The idea separated insurance from charity. A claimant would not be asking for a gift. The payment would be part of an organized system tied to employment. Europe moved earlier in several forms of social insurance. American reformers studied foreign programs and debated whether they fit a country suspicious of national welfare systems. Business groups worried about taxes and administrative cost. Some labor leaders feared that government benefits might weaken unions or be used to control workers. Others saw insurance as essential protection in an industrial economy. Before a national framework existed, a few American experiments tried to solve the problem. Employers sometimes created dismissal funds or guaranteed employment plans. Trade unions maintained benefits. Private proposals circulated. But voluntary systems faced a basic problem. The firms and workers most likely to participate were often those most exposed to unemployment, making adequate funding difficult. Employers that offered protection also carried costs competitors could avoid. Wisconsin became the first state to enact an unemployment compensation law in 1932. The timing was no accident. The Great Depression had turned unemployment from a recurring hardship into a national emergency. Wisconsin's experiment helped show that a public system was politically possible, but one state could not solve a crisis that crossed every border. The Depression revealed the old safety net's limits with brutal clarity. After the 1929 crash, production fell, banks failed, and businesses closed. Unemployment rose to levels that overwhelmed families, charities, and municipal governments. A person could search daily and find no job because millions of other people were searching too. The problem was not a shortage of effort. It was a shortage of demand. When a worker lost wages, the damage spread. The family cut purchases. The grocer sold less. The landlord struggled to collect rent. The local store reduced staff. Each act of necessary household caution weakened another person's income. Mass unemployment created a feedback loop in which lost wages produced lost spending, which produced more layoffs. Private charity could not keep pace. Donations fell because donors themselves had less money. Cities faced rising need and shrinking tax revenue at the same time. Relief rolls grew. Public officials borrowed, cut other services, or tightened eligibility. In many communities, the administrative system for helping the unemployed consisted of offices designed for a much smaller problem. The federal government gradually became more involved in relief and public employment. New Deal programs created work and transferred resources to states and localities. But emergency jobs and relief were not the same as permanent insurance. Reformers wanted a system ready before the next downturn, one that would automatically replace part of a worker's income without requiring Congress to invent a rescue after every crisis. The Social Security Act of 1935 created the federal state framework for unemployment compensation. The design reflected American federalism and political compromise. Instead of one uniform national benefit program, the federal government used a payroll tax structure that encouraged states to establish their own systems. Employers paid taxes, and states administered benefits under federal requirements. The arrangement solved a competition problem. If one state taxed employers to support unemployment benefits, while its neighbors did not, businesses might threaten to move. A federal tax with credits for contributions to approved state systems gave every state a reason to participate. The national government established the architecture, while states determined many rules. This division created durability and complexity. State systems could respond to local labor markets and political preferences. But workers in different states could receive different benefit amounts, durations, and access even when they lost similar jobs. A national economic risk was insured through a patchwork of state decisions. The basic principle was straightforward. During employment, payroll taxes financed trust funds. When an eligible worker lost a job through no fault of his or her own, the state paid a temporary weekly benefit. The payment was never designed to replace the entire wage. It was meant to prevent immediate collapse while the worker searched for another job. Eligibility rules carried the system's moral assumptions. A claimant had to demonstrate attachment to the labor force, sufficient prior earnings, and willingness to accept suitable work. Someone who quit voluntarily or was dismissed for misconduct could be denied. The program distinguished involuntary unemployment from other reasons for not working, continuing the older desire to separate deserving from undeserving claimants. but placing that judgment inside an insurance bureaucracy. Coverage was incomplete from the beginning. Agricultural and domestic workers were excluded from major parts of the original Social Security framework, exclusions that disproportionately affected black workers and women. Other categories were added over time. The system was a major expansion of protection, but it reflected the political compromises and inequalities of 1935. Now place a weekly claim card on a desk. It is a small bureaucratic object, less dramatic than a breadline photograph. The claimant writes a name, address, employer, and dates worked. There are questions about availability, job search, and earnings. A clerk checks the record. The form translates unemployment from a personal story into an administrative category. Beside it is a household budget. Rent is due. Food must be purchased. Coal or electricity keeps the home usable. Shoes wear out. A child needs medicine. The lost paycheck once covered all of these items. The insurance payment covers only a fraction. The family begins subtracting. Meat becomes less frequent. A payment is delayed. A relative is asked for help. The weekly benefit does not preserve the old life, but it may prevent eviction or hunger long enough for another wage to begin. This is the document under glass moment that reveals the system's real purpose. The claim card is not merely paperwork. It is a device for keeping a household connected to the money economy during a rupture. The budget shows why timing matters. Aid delivered after 3 months cannot pay rent due next week. Insurance works only when administration turns eligibility into cash quickly enough. The program also supports the wider economy. Because unemployed workers are likely to spend benefits immediately on necessities, the money moves into local stores and housing. Economists call this an automatic stabilizer. When unemployment rises, benefit payments rise without a new law for every individual claim. When employment returns, payments fall. The system pushes spending against the direction of the downturn. The first state programs had to build administrative capacity. Offices, employer records, wage reports, appeals, and methods for detecting fraud. This machinery was expensive and often frustrating, but it created something the earlier relief system lacked. The state now recognized unemployment as an event that could be documented, insured, and managed rather than merely judged. The Second World War reduced unemployment dramatically as military mobilization and war production created enormous demand. After the war, the system faced new tests during recessions, industrial transitions, and layoffs. Congress sometimes extended benefits when downturns lasted longer than normal state coverage. Each intervention raised the same question: how temporary should temporary assistance be when jobs do not return quickly? The program remained closely linked to conventional payroll employment. That worked best in an economy where workers had clear employers, regular wages, and stable records. It worked less smoothly for independent contractors, intermittent workers, people moving across state lines, and those with low or irregular earnings. The architecture of 1935 carried assumptions about what a job looked like. Technological change altered the claims process, but not the central tension. Paper forms became telephone systems and websites. Employer wage records became electronic. In theory, automation could deliver benefits faster. In practice, old software, identity verification, confusing rules, and sudden surges in claims could still delay help. Economic crises repeatedly exposed these weaknesses. During severe recessions, state trust funds could be depleted and administrative systems overwhelmed. Congress created emergency extensions or supplements, making federal involvement more direct. Critics worried about cost, fraud, or benefits discouraging a return to work. Supporters pointed to household survival and economic stabilization. The argument often focuses on incentives. If benefits are too generous or last too long, some claimants may delay accepting work. If benefits are too low or difficult to obtain, laid-off workers may lose housing, health, and the ability to conduct an effective job search. Policy tries to balance these risks, but the balance is political as much as technical. There is also a bargaining power effect. A worker with no income must accept the first available offer, however poor. A temporary benefit gives some time to find a job that better matches skills and wages. That can improve the quality of employment and prevent a downturn from permanently pushing workers into worse positions. The same breathing room the critics describe as delay can sometimes produce a more efficient match. Employers experience the system through payroll taxes, and in many states, their tax rates are influenced by layoff history. The idea is to connect the cost of unemployment partly to the firms that generate it, but experience rating can also discourage employers from hiring workers they may later need to release or encourage disputes over claims. Every insurance design changes behavior. Fraud has always existed, as it does in other large payment systems. Some people conceal earnings or misrepresent eligibility. Employers may misclassify workers or contest valid claims. Public discussion can magnify individual abuse until it appears to define the entire program. Accurate administration must prevent fraud without treating every unemployed person as a suspect. The deeper issue is whether job loss should be understood as an individual failure or a shared economic risk. The world before 1935 placed most responsibility on the household and local community. That arrangement rewarded saving and mutual aid, but it collapsed during nationwide depression. The new system recognized that modern employment connects workers to forces they cannot control. It did not eliminate personal responsibility. Benefits are temporary and partial. Claimants must meet rules and search for work. The program does not promise that every career will survive technological change or global competition. It promises only that a qualifying job loss will not instantly reduce income to zero. That promise changed the meaning of a layoff. Before insurance, dismissal could be the first step toward charity and public shame. After insurance, it could be processed as a covered event. The worker still faced fear and disruption, but the payment carried a different social message. The person had participated in the labor market and was entitled to temporary support while returning to it. The distinction between insurance and welfare remains politically powerful. People often accept a benefit more readily when they believe it was earned through work and payroll contributions. In reality, unemployment systems mix insurance principles, taxes, redistribution, and public policy. The label shapes legitimacy even when the financing is more complicated than an individual account. Today, many workers do not know exactly how unemployment insurance operates until they need it. The tax is usually paid by employers, the rules are hidden in state systems, and the benefit arrives only after a job disappears. Like deposit insurance or a central bank, it is an institution most visible during failure. The Friday pay envelope from the opening of this story and the weekly claim card in the middle belong to different Americas. In the first, income ends at the factory gate and survival depends on whatever private resources remain. In the second, the state acknowledges that employment can end even when a worker did nothing wrong and sends a limited payment across the gap. The newer system is not generous enough to make unemployment painless, and it is not uniform enough to treat every worker equally. Its exclusions and administrative failures have caused real harm, but it changed the basic architecture of risk. A layoff no longer had to be managed only by the person least able to control it. So how did Americans survive unemployment before 1935? They worked longer, saved when possible, doubled up with relatives, borrowed, sold possessions, sought charity, entered relief systems, and sometimes did not survive without lasting damage. The old arrangements could manage one family's bad luck. They could not manage the simultaneous collapse of millions of paychecks. The Great Depression forced the country to see that difference. When unemployment becomes mass unemployment, personal thrift cannot manufacture jobs. Charity cannot replace national income. A city cannot tax a vanished economy enough to support everyone left behind. The risk has to be shared across time, employers, workers, and governments. That is what unemployment insurance attempted to do. It converted a portion of wages during good times into a reserve for bad times. It built an administrative bridge between jobs. It made the claim that a market economy needs not only freedom to hire and fire, but also a mechanism for absorbing the human shock when firms stop hiring and begin firing. And that is why the debate never ends. The system sits at the boundary between work and survival, between private decisions and public consequences. Every recession asks the same questions in a new form. How much protection is enough? Who should pay? How quickly should help arrive? And how do you preserve the urgency to find work without allowing the loss of work to destroy everything a family built before it? The small claim card cannot answer those questions. It can only record that a job ended and a person is still ready to work. But that record represents a revolution in the way the country understands unemployment. Before 1935, the worker carried the risk home alone. After 1935, at least part of that risk belonged to the system that had produced the job in the first place. The protection is imperfect because the labor market keeps changing faster than the institutions built around it. Gig work, temporary contracts, and irregular schedules do not fit easily into rules designed for the stable payroll job. Yet the central insight of 1935 remains intact. A modern economy cannot treat every lost paycheck as an isolated moral story. Sometimes millions of careful, willing people lose work for the same reason, and the only response large enough to matter is one organized before the factory gate closes.